We're in stage 5, right now, November 18th, 2025. That's not opinion, that's pattern recognition. And if history repeats, and it always does, you have exactly 18 months from this moment until the bottom. 18 months from stage 5 to complete collapse. That's how long it took in 1929, from the moment the smart money saw the crack to the moment the Dow lost 89% of its value. 18 months. And we can map every single month because the pattern never changes. September 1929, stage 5 began. The market was at all-time highs. Everyone believed it would last forever. Insiders were quietly selling. Margin debt had reached dangerous levels. Valuations had detached completely from reality. The mathematics guaranteed what came next. Right now, in November 2025, we're at that exact same stage 5 moment. The indicators are identical. The Shiller P ratio sits at 40, higher than 1929's 33. Warren Buffett is sitting on $382 billion in cash, the largest war chest in history. Margin debt just hit $1.18 trillion, an all-time record. And for the past 3 days, markets have been falling. The crack is starting. The pattern recognition. Let me show you exactly why this isn't speculation. It's mathematics. September 3rd, 1929, the Dow Jones closes at 381, its all-time high. At this moment, almost nobody sees what's coming. The newspapers are bullish. Investment advisors are telling clients to buy more. But a few people see it. Joseph Kennedy is liquidating his positions. Bernard Baruch has converted to cash and government bonds. They understand something the crowd doesn't. When valuations detach from fundamentals completely, collapse is inevitable. And here's the critical metric they were watching. The Shiller P ratio hit 33 in 1929. Today, November 18th, 2025, it sits at 40. We're more overvalued than 1929. The historical average is 16. We're 119% above the historical mean. We're at the 99th percentile. Only 1% of history has been more expensive than right now. But it gets worse. Warren Buffett, the greatest investor alive, just reported his Q3 2025 position. $381.6 billion in cash. Let me repeat that. $381.6 billion. That's not just a record. That's more cash than Apple, Amazon, Alphabet, and Microsoft have combined. And he's not buying anything. For 12 consecutive quarters, 3 full years, Berkshire has been a net seller of stocks. In Q3 alone, he sold $12.5 billion and bought only $6.4 billion. He hasn't bought back a single share of his own company in 5 quarters, even though Berkshire stock has underperformed. Why? Because he sees what's coming, just like Joseph Kennedy saw it in 1929. Now look at margin debt. In 1929, margin debt hit dangerous levels right before the crash. Today, November 18th, 2025, margin debt sits at $1.18 trillion, an all-time high. It's grown for 6 consecutive months. It's up 45% year over year. As a percentage of GDP, it's at 3.88%, approaching the critical threshold of 3.97% that marked the 2021 peak before markets fell. And here's why margin debt matters. It's a mathematical trigger. When everyone owns stocks on margin and prices fall even 10%, their equity gets wiped out. Brokers issue margin calls. Forced selling begins. That selling pushes prices lower. More margin calls. More forced selling. It becomes self-reinforcing, and once it starts, nothing stops it until all the leverage is purged. The real economy is already rolling over. Unemployment ticked up to 4.3% in August, the last month we have data for before the government shutdown delayed reporting. But here's the terrifying part. Long-term unemployment, people unemployed for 27 weeks or more, now represents 25.7% of all unemployed workers. That's the highest since February 2021. It jumped 4.2 percentage points in just 1 year, adding 385,000 people. That's the kind of spike we only see at the beginning of recessions. Job growth in August was just $22,000, the weakest in years. And then came the bombshell. The annual jobs revision showed 911,000 fewer jobs were created than initially reported. That's the largest negative revision in history. We only see revisions like that at the end of recessions. Except we're not officially in a recession yet. Corporate earnings peaked. GDP growth is slowing from 1.8% this year to a projected 1.4% next year. Deloitte is forecasting an official recession beginning in Q4 2026. Tariffs are pushing inflation back up to 3.3% while wages stagnate. The foundation is cracking. And just like 1929, the stock market kept climbing even as the real economy rolled over, until it didn't. Right now, this week, November 17th and 18th, 2025, we're watching the market fall for 3 consecutive days. The S&P 500 closed at 6,672 yesterday, below its 50-day moving average for the first time in months. The Nasdaq is down 12% from its all-time high. The VIX fear gauge is rising. The crack is starting. We're in September 1929. And what came next in 1929 tells us exactly what comes next now. There are 6 signals that flash before every major crash. And right now, all 6 are flashing red simultaneously. Let me show you each one. Signal 1, insider selling. The people who know their companies best, the CEOs, the directors, the executives, they're selling. Berkshire Hathaway's Q3 portfolio filing just came out. Warren Buffett continued slashing his 2 largest positions. He's cut Apple by over 60% since early 2024. He's reduced Bank of America by 40%. His entire portfolio is now worth $267 billion, but he's holding $382 billion in cash. Think about that. He has more cash than invested stocks. The smart money has exited. Signal 2. Buffett's unprecedented cash position. $382 billion isn't just a record in absolute terms. As a percentage of Berkshire's total assets, cash is at the highest level in 34 years, over 30%, and he's not deploying it. His operating businesses generated $34.8 billion in cash flow in the first 9 months of 2025. He could buy. He could do massive deals. Instead, he made one strategic acquisition, OxyChem, for $9.7 billion, and banked the rest. He's waiting. Waiting for what? For the crash. For the opportunity to buy at 50 cents on the dollar, just like he did in 2008 and 2009. Signal 3, margin debt at the breaking point. $18 trillion all-time high, 6 consecutive months of increases, up 45% year over year. And here's the mathematical danger. The investor credit balance, the amount of cash and credit in brokerage accounts minus margin debt, just hit negative $790 billion. That's the lowest on record. Everyone is all in. Leverage to the max, there's no dry powder left. When selling starts, there are no buyers, only forced liquidations. Signal 4, valuations in the stratosphere. Shiller P at 40. That's the second highest reading in history, only exceeded by the dot-com bubble in 2000 when it hit 44. For context, the dot-com bubble peak was followed by a 50% market decline over 2 years. The 1929 peak of 33 was followed by an 89% decline over 3 years. We're higher than 1929. The Buffett indicator, total market value to GDP, sits at 209%, matching the 1929 peak. These are valuations that have only appeared twice before in history. Both times ended in catastrophic crashes. Signal 5, economic data deteriorating in real time. GDP growth slowing, unemployment rising. Long-term unemployment spiking to 25.7%. 1 in 4 unemployed workers, now jobless for over 6 months. The annual jobs revision, negative $911,000, the largest in history. Consumer spending projected to slow from 2.1% to 1.4%. Business investment projected to decline 2.3% in 2027. Recession forecasted for Q4 2026. Every leading indicator is rolling over. Signal 6, the sentiment shift is beginning. For months, everyone believed stocks only go up, that the Fed will always bail out markets. That AI justifies any valuation. But this week, right now, that's changing. 3 days of consecutive losses. The S&P 500 below its 50-day moving average. Nasdaq down 12% from highs. Doubts about AI spending are emerging. Concerns about fewer Fed rate cuts are spreading. The VIX is rising. The fear is starting. All 6 signals, flashing red. Simultaneously, just like September 1929, the 18-month countdown. Now let me show you exactly what happens next, month by month over the next 18 months. Because this pattern has played out before, and the pattern never changes. Phase 1. The crack. November to December 2025. We're already in this phase right now. The market has been falling for 3 days straight. The S&P 500 just closed at 6672, down nearly 1%. The Dow dropped 557 points. The Nasdaq fell almost 1%. We're below key technical levels. The VIX is rising. This is how it starts, not with a bang. With a slow, grinding pressure. Then comes the break. It might be triggered by a major earnings miss. Nvidia reports earnings this Wednesday, November 20th. If they disappoint, if they guide lower, if AI spending concerns are confirmed, that could be the catalyst. Or it might be a bank failure. A regional bank with too much commercial real estate exposure, or a geopolitical shock. The trigger doesn't matter. What matters is the system is so leveraged, so fragile, that any shock starts the cascade. Watch for a sharp single-day decline, 3% to 5%. Not unprecedented, but unusual. Then a rally the next day as institutions try to stabilize. Then another decline, bigger this time, 5% to 8%. Then the big one, 10% to 15% in a single day or over 2 days. That's the crack. That's October 1929, and when you see it, understand this. It's not the bottom. It's month 1 of 18, phase 2, the dead cat bounce. December 2025 through January 2026. After the initial crash, something unexpected happens. The market stabilizes, prices bounce. The Dow recovers maybe 10%, maybe 15% from the lows. And everyone breathes a sigh of relief. The newspapers say it was a healthy correction, that the excesses have been purged, that stocks are now attractively valued. Investment advisors tell clients this is a buying opportunity. Buy the dip, and some people do. This is the most dangerous phase, because it gives false hope. It convinces people sitting on losses that if they just hold on, they'll recover. It convinces people who sold that they made a mistake. The Fed will cut rates in December. They'll talk about supporting the economy. Markets will rally on the news, but underneath, the damage is spreading. Banks are taking losses on their loan portfolios, margin loans that can't be repaid, commercial real estate loans going bad. They're absorbing losses quietly, reducing lending to preserve capital. Businesses are starting to feel the squeeze. Credit is tighter. Orders are down. They begin laying off workers. Unemployment edges up to 4.5% by year-end, then starts climbing toward 4.8% in early 2026. People who lose jobs can't make mortgage payments. More defaults, more losses for banks. The cycle is starting, but most people don't see it yet. They're focused on the market stabilizing. They think the crisis is contained. It's not. And the people who bought the dip in November and December 2025 will watch their portfolios get cut in half over the next year, then cut in half again. Buying the first dip is one of the most expensive mistakes in investing. Phase 3, the grind, February through June 2026. This is where most of the psychological damage happens. The market doesn't crash, it grinds. Down 3% in February, down 5% in March. Up 2% in April, hope. Then down 7% in May. Down 4% in June. Every month a new low. Every rally fails. The economic news gets progressively worse. Unemployment climbs from 4.2% to 4.8%. Job growth stays below 30,000 per month. We're already at 22,000. Corporate earnings miss expectations quarter after quarter. Major companies announce layoffs, thousands at a time. Regional banks start to fail. You hear names you've never heard of in cities you don't know about. But each failure makes people more nervous. Tariffs are pushing inflation back up. Core PCE hits 3.3%, but wages aren't keeping up. Real incomes are declining. Consumer spending slows to 1.4%, down from 2.1%. Retail sales disappoint month after month. GDP growth slows to 1.4% annualized. Business investment is declining. The recession is beginning, even if it's not official yet. And the market reflects the despair. By June 2026, the market will probably be down 50% from the November 2025 peak. The S&P 500 from 6,700 to 3,350, trillions in market value, gone. And most retail investors will still be holding, still hoping, still believing it will recover. They'll have watched their 401ks cut in half, watched their net worth evaporate, and they'll be exhausted, emotionally drained, psychologically broken. That's when Phase 4 starts. The phase that finishes them. Phase 4, capitulation, July 2026 through March 2027. The market has been grinding down for 9 months. People are exhausted, and then it accelerates. July, the market falls 15%. August, another 12%. September, 18%. It's not a grind anymore. It's a collapse. What's happening is forced liquidation at scale. Individuals who held on, hoping for recovery, finally give up. They sell. Mutual funds getting redemptions have to sell to raise cash. Banks that need liquidity sell their stock holdings. Insurance companies facing claims sell. Pension funds trying to meet obligations sell. Everyone's selling, nobody's buying. And when there are only sellers and no buyers, prices crater. By October 2026, the official recession is confirmed. Q4 data shows 2 consecutive quarters of negative GDP growth. Unemployment hits 5% and keeps rising. Business investment has declined 2.3%. Corporate bankruptcies are surging. Companies that were icons start to fail. Banks fail in clusters, not one or two, dozens. The FDIC Deposit Insurance Fund is depleted. Some depositors lose money even with insurance. The national debt crosses $39 trillion, then $40 trillion. Interest payments consume 18%, then 19% of the federal budget. The deficit balloons to over $2 trillion annually as tax revenues collapse and safety net spending explodes. Sovereign debt concerns emerge. The dollar weakens. Everything is falling apart. By March 2027, 18 months from right now, the market is down 60% to 70%. The S&P 500 sits somewhere between 2,000 and 2,700, down from 6,700. The Dow has fallen from 46,000 to under 15,000. The Nasdaq, packed with overvalued tech stocks, is down 75%. Trillions in wealth have vanished, not disappeared, transferred, from those forced to sell to those positioned to buy. But here's the critical difference between 1929 and 2026. This is why this crash is worse. This is why the American dream won't recover. In 1929, when the crash came, the foundation of the American dream was intact. Social mobility was high. Children born in 1940, right after the Depression, had a 90% chance of earning more than their parents by age 30. 90%. The dream was alive. The foundation existed to rebuild. And over 25 years, America recovered. The dream survived. But in 2026, the American dream is already dead. It died decades ago. We just haven't admitted it yet. Children born in the 1980s have only a 50% chance of out-earning their parents. 50%. The middle class has been devastated. For those born into the 50th percentile, true middle-class families, the rate dropped from 93% in 1940 to just 45% in 1980. The collapse happened over 40 years, slowly, quietly, and nobody noticed because the stock market kept going up. But the research is clear. The decline in absolute mobility, the ability to do better than your parents, isn't caused by slower economic growth. It's caused by inequality. If we had maintained today's GDP but distributed it like we did in the 1940s, absolute mobility would be 80%. We'd have reversed 2/3 of the decline. But if we increased GDP growth to 6% per year, double the current rate, but kept today's inequality, mobility would only reach 62%. Growth alone doesn't fix this. The problem is distribution, and the inequality is staggering. The U.S. Gini coefficient, the measure of income inequality, sits at 0.434, the highest in the G7, the highest among all developed nations. In 1964, the average hourly wage was $20.27 in today's dollars. In 2018, it was $20.65. That's an 11.7% increase over 54 years. Essentially flat. Wages have been stagnant for half a century while productivity soared and corporate profits exploded. The result? 9 million Americans work multiple jobs just to survive, not to get ahead, to survive. They're living paycheck to paycheck with no ability to save, no ability to invest, no ability to build wealth. Student debt crushes younger generations. Housing is unaffordable in every productive metro. Healthcare costs are astronomical. The barriers to upward mobility are structural and insurmountable, and people know it. A 2025 survey found that 60% of Americans no longer believe that hard work guarantees economic opportunity. 60%. That's the core promise of the American dream. Work hard, play by the rules, and you'll get ahead. And 60% don't believe it anymore. Among lower-income Americans, only 39% believe the dream still exists. Among upper-income Americans, 64% still believe. The divide is stark. The wealthy still believe in the system because the system works for them. Everyone else has given up. This is the foundation we're entering the crash with. Not the strong foundation of 1929, when 90% mobility was intact. But a rotted foundation where only 50% mobility exists, where wages have been flat for 50 years, where inequality is at historic highs, where 60% have lost faith in the system entirely. When the crash comes, when unemployment hits 5%, then 6%, then 7%. When businesses fail and banks collapse and homes are foreclosed, there is no foundation to rebuild on. The American dream won't recover from this crash because the American dream was already dead. The 1929 crash killed wealth. The 2026 crash will kill hope. And hope once lost doesn't come back. So what do you do? How do you survive this? How do you position yourself on the right side of the wealth transfer instead of the wrong side? There are 4 phases, 4 decisions, and the first one needs to happen right now, today, November 18th, 2025. Phase 1, de-risk now. This is your last window. Right now, as I'm speaking, the market is already declining. 3 consecutive days of losses. The S&P 500 at 6,072. The crack is starting. You have days, maybe weeks before the real break comes. If you're heavily invested in stocks, 80%, 90% of your portfolio, you need to reduce exposure immediately. Get to 50% or less. Take profits. Sell your winners. Yes, you might miss the last 5% or 10% of gains if the market somehow rallies into December, but you're protecting yourself from a 60% to 70% decline. Do the math. If you stay fully invested and the market falls 65%, you lose $650,000 on a $1 million portfolio. If you de-risk to 50% now and miss a final 5% rally, you miss $25,000 of gains. Then when the market falls 65%, you only lose $325,000 instead of $650,000. You're $300,000 better off. The math overwhelmingly favors de-risking now. Sell speculative stocks immediately. Anything that's up 100% or more in the last 2 years. Tech stocks with no earnings. Meme stocks, SPACs, anything trading on narrative rather than fundamentals. These will be the first to collapse and they'll fall the hardest. In 1929, RCA fell 97%. The speculative stocks went to nearly zero. Consider buying protection. Put options on SPY or QQQ expiring in 6 to 12 months. Allocate 2% to 3% of your portfolio. If the market crashes 50%, those puts will return 10 to 20 times what you paid. If the market doesn't crash, you lose the premium. That's insurance. You buy it hoping you never need it. But if you need it, it saves you. Move your cash to short-term treasury bills. You'll earn 4% to 5% risk-free while you wait. Warren Buffett has $382 billion in treasuries right now, earning $12 billion annually risk-free. Follow the smart money. Phase 2. Don't buy the dip. December 2025 through January 2026. When the first big decline comes, 10% to 15% in a week or two, don't buy. Everyone will be screaming that it's a buying opportunity. Every financial network will have experts saying the fundamentals are strong. This is just a correction. Buy the dip. Ignore them. They said the exact same thing in October 1929. It's month 1 of 18. When the market stabilizes and rallies 10% to 15% in December or January, don't think you missed the bottom. That's the dead cat bounce. That's the false hope. Use that rally to sell anything you haven't sold yet. Get out during the bounce because the next leg down is coming. Phase 3. Do nothing. February through June 2026. This is the hardest part. Sitting in cash while the market grinds lower. Every month brings new lows. Every rally fails. The news gets worse. Your friends are losing jobs. Your neighbors are struggling. The temptation to do something, anything, will be overwhelming. Don't buy because stocks look cheap. They'll get cheaper. Don't panic sell everything if you still have positions. If you de-risked in phase 1, you're in cash. Just wait. Do nothing. Let the market come to you. Watch it fall from 6,700 to 5,000 to 4,000 to 3,500. Every instinct will scream at you to act. Resist. This is the time that separates those who build wealth from those who lose it. Patience, discipline, nothing. Phase 4. Deploy at capitulation. July 2026 through March 2027. This is when the real opportunity appears. When the market has fallen 60% to 70%. When unemployment is 5% and rising. When everyone is terrified. When the news is apocalyptic every single day. When your friends and family think you're insane for even considering buying stocks. That's when you deploy capital. Not all at once. Scale in over months. Start when the market is down 50%, around 350 on the S&P 500. Add more when it's down 60%, around 2,700. Final deployment at 70% down, around 2,000, and only buy quality. Companies with strong balance sheets. Low debt. Essential products. Companies that will survive and thrive: Apple, Microsoft, Visa, American Express, Coca-Cola, Johnson & Johnson, Procter & Gamble. Names that won't go bankrupt, names that will still be here in 10 years, and you buy them at 50% to 70% off their peak prices. This is the wealth transfer. This is when wealth moves from forced sellers to positioned buyers. The people who bought in 1931 and 1932 at the bottom made fortunes over the next 20 years. The people who bought in 2009 after the financial crisis, a simple S&P 500 index fund in March 2009 returned over 500% by 2019. The people who buy in 2026 and 2027 will make fortunes in the 2030s. But you have to survive to get there. The final warning: 18 months. That's how long it took from stage 5 to the moment when most of the wealth was destroyed. September 1929 to March 1931. And we're at the September 1929 moment right now, November 18th, 2025, which means March 2027 is the 18-month mark, the moment when the market will have fallen 60% to 70%, when most retail investors will have lost most of their wealth, when the transfer will be largely complete. This isn't prophecy, this is pattern recognition, the same signals, the same stage, the same mathematics. Shiller P at 40, higher than 1929's 33. Warren Buffett with $382 billion in cash, more than he's ever held, more than anyone has ever held. Margin debt at $1.18 trillion, an all-time record, up 6 months straight. Markets falling right now, this week as we speak. 3 consecutive days of decline, below key technical levels. The VIX rising, the fear beginning. The economic data is rolling over. Unemployment at 4.3% and climbing. Long-term unemployment at 25.7%, 1 in 4 unemployed workers jobless for over 6 months. The largest negative jobs revision in history. GDP growth slowing. Recession forecasted for Q4 2026, every leading indicator pointing down, and underneath it all, the foundation is already broken. Social mobility collapsed from 90% to 50%, only 45% of middle-class children out-earning their parents, wages flat for 50 years. Inequality at the highest level in the developed world, 60% of Americans no longer believing that hard work guarantees opportunity. The American dream already dead. The mathematics doesn't care about optimism or hope or belief. It just executes. You can see this coming or you can be blindsided by it. You can position yourself on the right side of the transfer or the wrong side. You can be the person with cash buying assets at 50% off or the person forced to sell at 50% off.